If you have been hearing phrases like no tax on tips, no tax on overtime, or no tax on car loan interest, I want to slow that down and translate it into actual tax language. The way this is being talked about online makes it sound like those paychecks suddenly won't be taxed at all. That is not how this works. What we actually have for the 2025 tax year, meaning the return you are filing now in 2026, are new deductions with specific definitions, dollar limits, and income phaseouts. Deductions reduce your taxable income. They do not automatically change what comes out of your paycheck during the year, and they do not eliminate payroll taxes like Social Security and Medicare. In this video, I'm going to walk through the three provisions most relevant to individual taxpayers, using IRS guidance as the anchor. Quick disclaimer: this is general education, not personal tax advice. If you want someone to apply these rules to your exact situation, talk to a qualified tax professional. Let's walk through the three items. First, the deduction for qualified tips. For tax years 2025 through 2028, there is a deduction for qualified tips of up to $25,000 per year. There is an income phaseout that begins at $150,000 of modified adjusted gross income, or $300,000 if you file married filing jointly. When the IRS says qualified tips, they are referring to voluntary tips received from customers in occupations that customarily and regularly receive tips. This is aimed at traditional tipped roles such as servers, bartenders, and similar positions. It does not apply to every situation where income is labeled a tip, and it excludes certain higher-earning service businesses, so professional fees cannot simply be reclassified as tips. For many taxpayers, 2025 is a transition year. You may not see a clean, separate line on your tax documents that clearly says qualified tips. For this filing season, the IRS allows you to use the amount shown as Social Security tips in Box 7 of your W-2, along with any additional tips you properly reported, such as on Form 4137, to determine the amount of qualified tips for the deduction. This is why documentation matters. Now let's move to the second provision, the deduction for qualified overtime. This one is probably the most misunderstood. It does not mean all overtime pay is tax-free. The deduction applies only to the premium portion of overtime pay, the amount paid above your regular rate. Here's the simplest way to think about it. If your regular rate is $20 an hour and you're paid time and a half for overtime, you earn $30 per overtime hour. That $30 consists of $20 of regular pay and $10 of overtime premium. Only the $10 premium portion is what potentially qualifies for the deduction. There is a cap of $12,500 per year, or $25,000 if you file jointly. The income phaseout is the same as the tip deduction, beginning at $150,000 of modified adjusted gross income, or $300,000 for joint filers. If your pay stub clearly shows overtime premium as a separate line, that makes the calculation straightforward. If it does not, the IRS provides a practical shortcut. For time and a half overtime, the premium portion is 1/3 of the total overtime paid. So you take the total overtime amount and divide it by 3 to estimate the premium portion. This deduction is claimed on your tax return even if you take the standard deduction. You do not have to itemize to benefit from it. The practical advice here is simple. Keep your year-end pay stubs or payroll summaries. If you worked significant overtime, those records support the calculation. Now the third provision, the car loan interest deduction. This one has the most fine print. For tax years 2025 through 2028, there is a deduction for interest paid on a loan used to purchase a qualified vehicle for personal use. This does not apply to leases. It applies only to interest on a qualifying loan, and the rules matter. First, the vehicle must generally be new. Used vehicles do not qualify under this provision. Second, the vehicle must have undergone final assembly in the United States. You can verify this using the vehicle's door jamb sticker or by checking the VIN through an official VIN decoder. Third, the loan must have originated after December 31st, 2024, and it must be secured by a lien on the vehicle. Fourth, the vehicle must be for personal use, not business use. And finally, when you claim this deduction, the IRS requires you to include the vehicle's VIN on your tax return. The maximum deduction is $10,000 per year. The income phase-out for this deduction is lower than the others. It begins at $100,000 of modified adjusted gross income, or $200,000 if you file married filing jointly. So while this deduction can be valuable, fewer taxpayers will qualify once income is factored in. Let's wrap this up. For the 2026 filing season, these provisions are real benefits, but they are not slogans. They are deductions with definitions, caps, and income phase-outs. If you qualify, they can reduce your taxable income in a meaningful way. But accuracy matters, and documentation matters. Keep your records, year-end pay stubs for overtime, proper tip reporting and logs, and your car loan interest statements along with vehicle documentation. That's how you claim these correctly. This is Finance 101.